Hi and welcome. I'm Steve Johnson, Chief Investment Officer here at Forager Funds. Today we're talking about an ASX-listed stock called Fineos, and I'm joined by the analyst who knows this business inside out, Gaston Amoros. How are you, Gaston?
Hi, Steve. I'm very well, thank you.
Look, this is an important investment in our Australian shares fund, but I also wanted to use this particular stock to give you an insight into our investment process and how we monitor our thesis for a particular investment over time. Sometimes they go wrong, sometimes they go well, but it's really important to have markers along the way to see how that investment is unfolding. And we're going to use this as an example to talk about that process internally. Maybe kick us off though, Gaston, with explaining exactly what this announcement from Fineos was earlier in the week.
They announced that they landed a big new customer. It's a company called Guardian Life. It's a US insurer. It's classified as a tier 1 insurer. They write group benefit premiums for around $5 billion per annum, and they sign a deal that is it's a multi-year deal. It starts with 5 years, but these things tend to last longer than that. The initial quantum of revenue for Fineos is around 10 to 14 million US dollars on the first year, and it grows from there. They haven't given us exactly the exact cadence, but you can tell that it's I have less revenue growth in FY24 than this amount, so you could say that it significantly de-risks the near-term outlook.
Now, this was a company with a market capitalization north of 400 million euros. It's already doing 125 to 130 million euros of revenue this year, 10 to 14 million dollars US dollars. I mean, it sounds useful to me, but it doesn't sound like something that's going to dramatically change the value of the business. Why is it important?
Well, it's important for a variety of reasons. First, it breaks a bit of a dry spell of a couple of years with, they had announced a few small wins here and there, but they were essentially growing 15-20% per annum on the software side of the business, just with like existing customer base, right? With no new big deals. So this is a growth on top of that. So this will continue to fuel growth, hopefully for years to come. So that's point number one. Point number two is it serves as validation that the technology they built over the last few years works, is good, and tier 1 customers want it. And they're making good inroads in terms of monetizing that. And last but not least, it's important because Guardian Life is taking all the modules that Fineos has produced. It's not just claims, which is what they were initially known for. They're taking all the other modules as well. So it's again good proof that the 200 million euros that we reckon they spent over the last 5 years building software, it's put into good use.
Yeah, I went back and read the original piece of research here this morning, and the top two things here are 10 to 15% annual revenue growth from existing customers as they add what we call seats or licenses, and also as they add new products. But for the business to get where we want it to get to, point number two was new big client wins. And I've been nagging you for the whole time we've been owning this investment. They've invested enormous amounts of money into this product. When are we going to see the benefits of that? And I think this is some validation that that investment is actually going to be money well spent.
Mm-hmm.
So what does the market opportunity look like here? This company's at 200 million Aussie dollars of revenue, getting up there in terms of Aussie tech companies, but it is a global business. What does the market look like for their opportunity?
So just to give you a bit of context, their customers, life insurance vendors, they're very slow moving, but when they do move, they tend to be big dollars, and they tend to be very sticky revenue for someone like Fineos. The rule of thumb is they spend around 1% of their revenue or gross written premiums in software. So if you think about $200 billion of premiums, life premiums in the US alone, we're talking about $2 billion of addressable market for Fineos. When you put that in comparison with 60 million euros of revenue on the software side, you can see there's a lot of room for growth, many years of healthy growth ahead if they manage to get a decent share of that.
Yeah, the insurance sector is generally very large behemoths that are very slow moving, and I think anyone that's engaged with these insurance companies as a customer would realize they've done a lot of acquisitions over the years. There's a lot of different systems. It is really, really early in terms of them migrating to modern cloud-based software that's really going to help their business. So this contract win on top of another reference client that they have, I think is really going to leave them in pole position here to win more and more of those new clients.
Absolutely. They are becoming, with New York Life and now Guardian Life, they are positioning themselves as the de facto leader or emerging leader in one particular line of business in absence management, but that puts them in a very good footing to become the leader in life insurance software.
This business overall is not going to be profitable this year. They're guiding towards stepping closer to profitability next year, maybe cash flow positive. When does this business start to turn this sales growth into profits for shareholders?
Well, so what they said is that they'll be free cash flow positive as of second half of FY24, so this year that we're about to start, and that has to do with the seasonality. They usually send a lot of invoices in the first half, so in December, and they get paid in the fiscal Q3, so that's why the big seasonal gap in free cash flow. But as they continue to grow, and this deal is validation of growth from new customers on top of the growth with existing customers, you would expect those margins to get, as the business matures, to get towards a typical 20 to 30% EBITDA margins that we see from more mature software vendors around the world. And when that happens, that you become a very cash flow generative business. So that's in the terminal year. That's what we have in our model.
And in some ways, we're hoping that terminal year is as far away as possible, given the growth opportunity that's in front of it. We want this business to grow for a long time, and there's plenty of peers out there that you can look at and get confident about where that margin is going to be eventually. But we want it to grow for the foreseeable future. Hope that's given you some insight into how we monitor these investment theses as they go along. It is as important for investments that don't work out as the ones that do. And this has been one that we've been a bit nervous about for the past 18 months because of the lack of new contracts, but it is a nice big tick here next to an important part of this thesis for us, and looking forward to seeing that translate to revenue growth and ultimately profitability over the coming years. Any questions, please let us know, and thank you for tuning in.